it's welcome, but it's mild, and so it's not going to make a big difference in household budgets right now.
While the Bank of Canada's interest rate cut is being welcomed, for Canadians, it's only a little bit of relief as rates still remain well above what they were just a few years ago. A quick glance at the central bank's key interest rate over the years, and you can see Canadians who once enjoyed a 0.25 rate back in 2020, seeing it climb to 5% in 2023. It's why, despite the Bank of Canada announcing it's cutting its key interest rate by a quarter percentage point from 4.75% in June to 4.5% now, it's not providing a whole lot of relief.
4.5% is still relatively high. And for businesses and individuals, that means that borrowing costs remain high. Some of our most recent business barometer data, which tracks business confidence and overall financial health, businesses are indicating that borrowing costs are the biggest constraint that's limiting them from growing and expanding.
If you're looking to renew your mortgage, there's still payment shock there from what you're probably coming out of in terms of a fixed rate. If you're in a variable rate, you're going to see about a 2.5% reduction to your principal and interest payment.
University of Manitoba economics professor Fletcher Barriger says Canadians might see more smaller rate cuts rather than steeper ones if the central bank continues this direction.
I sense that they're cautious. They don't want it to sort of turn the other way, and so therefore I suspect it'll be slow, very slow, and gradual, very gradual.
While Canadians have been holding off spending, that really hasn't thrown off our real estate market here in Winnipeg compared to other major cities in Canada.
Winnipeg has performed very well. We've actually been ahead in activity and sales for the first half of the year. Prices are up at a modest amount, which is good.
In the meantime, though, households have some work to do in terms of squaring their budgets.
In Winnipeg, Edward Jan, City News.